live webinar. You're going to love this one because I'm hoping to be joined by Paresh as well on this. You know, as co-founder of a massive multi-billion-dollar hedge fund, everyone sort of thinks, who is the other guy? But so Paresh might be joining on this one as well. I want to jump right into it to save you time. Let me know, as ever, where you're from, if it's your first time on here. And I've got new files and folders and things to share with you. I'm going to go into the chat. Barry, hello. Cardiff, we've got in the room. Mark, Graham, Bedford, Scotland's in the room as well. Wonderful, wonderful, wonderful. Great to have you all on. So as well as the 10 pension rules, I've said 10, I've probably given 50, I don't know. I want to go through the stock market update, all the usual stuff that I do, and give you new insights. We seem to have peace in the Middle East, by the way, which should be helping the stock market no end. And it's amazing how the media refused to give Donald Trump any credit for it. The fact that the threat was by Biden, you better sign, otherwise the next guy's going to carpet bomb half the Middle East, is probably what got the ink on the paper. But anyway, they won't give it to us. You know, it seems quite weird. Well, not weird. It seems quite, I guess. Weird. Oh, yeah. The Dow is up 760 points. The NASDAQ is up 500 points. Good God. Okay, as I speak. So anyway, I should say, never mind as I speak, as I live and breathe. What was nice was Biden recognized both the travesty of what's happening in Palestine. So he was, and of course the hostages. So he mentioned both sides. Anyway, let's get into the webinar over here. And where are we on valuations? What you're seeing on screen here is that you're paying $27 for every dollar of expected profit in Microsoft. So as you can see from this, and I'm going to come to UK as well in this in due course. I'm pretty sure I've got some of the UK stuff. Yeah, I'm going to come to some of the UK stuff as well on this. Where normally I don't cover so much on the UK, but I think you know, people might be interested, so I will sort of go through it a little bit later on. And just go through some of the UK kind of companies and what they look like, how they look to us. But just looking at the US for a second, you might think, well, okay, why would I want to pay $27 for a future expected dollar of profit in Microsoft when I could get JP Morgan, which I own, as you will know if you watch these, and Goldman Sachs, which I own, and Bank of America, I'll talk about a little bit later, which I don't own, if I can get them cheaper, or indeed telecom services like Verizon, for $8 for every future dollar of profit. The reason is because growth expectations are important. And we're going to come a little bit later on. I think we're going to talk Walmart and Costco, which are always good for dipping into for profits, but not ones you want to buy and hold forever, because you'll get years where you get taken to the cleaners. Tesla, you're paying $120 when you buy a share of Tesla for every dollar of expected profits. Well, you could argue the expectations are wrong, because when they start flying cars to Mars, and doing time travel, that looks cheap. The point is, valuation is not the only thing. Thank you, Mohammed, for your message. I'll answer that a little bit later on, that question. And we've got Northern Ireland, Carwyn from Northern Ireland as well. Scotland, Brian also from Northern Ireland. Now, growth, value, income, all of these other factors are important, and that's what people often miss when they say, oh, markets are expensive. They often miss that. And value, according to the academic literature, is valuation, i.e. what you're paying for profits, is an important metric, but not the most important. In fact, there's many different ways of working out valuation. Obviously, the price is what you pay for the shares, but what are the assets worth? What are the profits? Could be priced to the amount of cash it generates. There's lots of different measures of valuation. So we won't complicate things, but what I'll tell you is what I think are the most important. By the way, the earnings calendar, you can take a picture of this. We are now in earnings season, which is good, because that's when the markets start moving. In fact, today's moves are astronomical from what I can see. I'm on here, so I've not had a chance, but I suspect it's to do with the Middle East, because that seems the biggest story. So JP Morgan, Wells Fargo, Goldman Sachs, all of these are reporting. And now in this busy season, you've got Netflix coming up. We'll look at some of these stocks as we go forward. And what key factors will drive the market, I'm going to discuss as well. Now, because value is not the only factor, this is my secret sauce, and I'll come to, it's the basis on which I've done this webinar. Okay, the basis on which I've done this webinar is to say, as some of you who are regulars will know, but for those who aren't, we need to look at the valuation of a company. We need to look at its revenue growth. We look at its dividend yields. We look at all 10,000 US, UK stocks, which can go in my SIP and ISA. But we want to make sure we haven't missed anything, because I don't want to gamble by not looking at certain pieces of information. I first started looking at it this way, I guess, before I even set up the hedge fund, which was in 2004, when I was still doing my Bloomberg TV show, my Financial Times columns. This was the rudimentary elements of the approach, which is, why would I not want to tick every box? It's got to be an undervalued company which is growing, producing dividend yields. This was from Goldman Sachs Wealth Management, which shows the amount of cash a company can generate for the capital it spends. This was from the hedge fund industry, the momentum, because we know trends tend to persist, but they're not guaranteed to, but they tend to, and there's lots of academic literature on that as well. The major hedge funds in this, I mean, if you're a Liverpool fan, J.W. Henry, your football team is owned by a trend following hedge fund manager who tends to look only at this. Okay, so it can make you stupidly rich. Sortino and Alpha, again from the hedge fund industry, it's a way I cheat. Okay, because what I do is we look at the prices. We don't just look at the balance sheet, profit and loss, and cash flow statements, the three accounts all companies have, to decide what's an undervalued, high growing, dividend yielding company. We then look at the stock price and say, well, what consistently has a high average return with very little dips to the downside? Now, the past is not a guarantee of the future. If you're looking for a guarantee of the future, you need to go and buy a time machine. This is the only thing that guarantees the future. Okay, but the past can act as a good guide, because if it didn't, then how come some stocks continue going up in the same direction? What we don't do is spend our time and energy on narratives and stories and speculating on, well, that'll be the next big thing, or this will. So the reason we could capture an NVIDIA in January 2023 is because the numbers on here. It wasn't because I knew anything about AI or that AI was coming. It was because they were generating great numbers. In fact, they were generating great numbers because of their graphic cards were data mining cryptocurrency, which people forget. And that then the AI story just gave them explosive growth to the upside. We didn't know the AI story would do that. I don't think they knew. I don't think anybody knew. Okay. The point is, balance sheet, cash flow statement, P&L, that's in there. Valuation, growth, income, cash flow from Goldman Sachs, consistent high price. If there's a box we haven't ticked, and obviously we've got volatility just to check. If you're risk averse, first thing you got to know, what's your risk appetite? If you're risk averse, make sure you only pick things with volatility under 10%, i.e. low volatility. If you're sort of risk neutral, 20% or below, and if you're not concerned about risk or more risk loving, it doesn't matter what the volatility is. Less volatility or risk in the share price doesn't mean lower returns, because I can prove it statistically. It doesn't. What it means is less choice of the kinds of companies for the returns you want. Okay? It means it'll take you longer and harder to find them, which is why Warren Buffett has to sit on a lot of cash, because he's got a very high bar. And I recommend a high bar. All other things being equal, I think you should try and keep volatility as low as possible for obvious reasons. It's no fun, but still keep that momentum bar, as you can see here. Look at this. You can have a 15% volatility and still get a 21% return in 6 months, or a 40% volatility and just get marginally different, not much different. Do you see? So it isn't necessarily higher volatility means higher returns. It's just harder to find. Okay, and that's our job, and we're helped by this lovely little ratio, which what it looks for is that, and any dips are small. Whereas if you don't have that, then you could be doing all this and hoping that high volatility can get you on a sort of a wind draft and you'll get some tailwind, hopefully. Well, that's not the way to do it. That's how fund managers pick stocks. They go for volatility in the hope that, look, some point it might go up, sometimes go down. We don't. We want to try and get consistent, and we're still not guaranteed it. Okay. in the future. So that gives you an overview of all of that. Okay, Mark, thank you for your question. I will answer some of these, and I'm going to do quantum as well. So do keep the questions coming. I will answer all of them, I promise. But thank you for this, and I'll come into more detail on that. So as they occur to you, post them. I will answer them in batches, and I'll stay here as long as it takes to answer them. So over the past week, this is what's happened with the market. Now, don't read too much into it, because by tonight's market close, in a few moments, if I update this, it's going to look different. Okay, we're here to invest. Investing means holding for 12 months. We're not here to trade. From the hedge fund side, my background's in trading. My first book in 1997, The Mind of a Trader, was my interviews with the world's leading traders, because from university I wanted to be a trader, so I thought I better speak to the world's best traders, people like Bill Lipschutz, David Kite, which is how I know Paresh, because he worked for David. David is in the UK rich list as one of the best traders in the world. These were in the book they taught me, and the interviews the Financial Times published. The point is, that's trading, and it is my background. We're talking about investing today, which is holding for 12 months. Don't mix the two. Never discuss both in the same webinar, because it confuses people. Okay. Now, just because in a week these have gone up, does that mean we just dive into all of these? No. We need evidence of value, growth, income, cash flow, Sortino, alpha. We need to tick those boxes, because just as a matter of logic, if you are making a big decision in life, such as where to put your pension, do you not feel who to marry? Do you not think you should look at everything, or should you just roll the dice? I know some of you are going to say, oh boy, I've learned that. You don't roll the dice. It's too important. It's too important, not least because I'm going to discuss how I handle my son's ISA and SIP. Sorry, my son's ISA and my wife's SIP. And I'm not going to bloody roll the dice on that. I'm telling you what I do and the standard to which I'd want to hold it, which logically will make sense to you. Guess what most people do? Well, you already know most people spend more time on picking a washing machine than they do on looking at a new house before making an offer on it. Okay, we know that. That's what the data shows us. More people will gamble on their pensions and ISAs, spend less time on making sure all those boxes are ticked than they will on picking, I don't know, the next bloody iWatch or something. Humans are irrational. I want to make sure my Excel spreadsheet has ticked every single box. And if you don't have that approach, run for the hills. You're gambling. Okay. Past year has looked like this. Now, that's obviously been a good year. 2024 was a good year. 2023 was a good year. 2022, the markets were down. We had to hold cash most of the year. Okay. Because it was falling. And what can you do? If it's falling, and I'll show you the few things that rose. Well, I didn't have the balls to buy the 2 or 3 stocks that rose in a down year. Okay, so let's be honest, right? So what does the average become? Well, the average becomes extremely high years, a bit like climate change. You get really hot years like 2023 and 2024, and you get really cold years like 2022. You don't get a middle average, balmy kind of day. Okay. As well, thank you, Stephen, for that as well. Hi, Roger from beautiful Esher. My sister lives there. Now, past year, that's what it looked like. Now, what I would say is, see that rough mix of stocks and the numbers. I think over the next 2 years, not 1 year, 2 years, we're going to get a replica of that, but not necessarily the same stocks with the same returns. In other words, it might not be Amazon getting 40% over 2 years. It might be, I don't know, Cisco, let's say, and Amazon getting 17. In other words, I think we're going to get the same blanket, but I think it's going to be in different stocks. That's what I actually think is going to happen. Okay. And I'm going to tell you an easy way to handle that and a more complicated way to handle those returns to try and capture some of those. By the way, interestingly, Walmart, Costco, 2 which I always try and keep an eye on because they deliver. They don't deliver every year. Okay, even Meta dropped 70% in 2022, the year we had to hold cash, because companies like that can drop so much. So my point is, there are some which you can keep coming back to, but you don't want to buy and hold forever. Most years you want to hold, but 1 or 2 years you want to stay bloody clear when they're going to drop 70. Okay, York, Viola, welcome, welcome, welcome. So for those interested in these things, price to earnings ratio, that means you're paying $31 for every dollar in profit. And we'll talk about UK in a second. For the UK market, US market, it is, yes, historically, it is expensive. It is a market which is worth 61 trillion, which is 2 times the size of its economy. Its economy is 30 trillion GDP. Profits are 1.9 trillion of all those stocks. Revenues are 22. Revenues have gone up. Profits have gone up. prices have gone up even more than revenue or profits. That means the stock market's got more expensive. Does it mean it's going to crash? Not necessarily. Well, because nothing's guaranteed. If it was guaranteed, I'd bloody short the market. What it means is we're going to have to be more cautious. We're going to have to, be more cautious, be more picky, and be more observant. It's not a case of buy and forget, though I don't know which year is. 2024 was only buy and forget in hindsight. During it, I don't think I had a week. Well, maybe there were 1 or 2 weeks where I thought, oh, don't need to worry. But most of the time, it was like, better keep an eye. Yeah, looks okay. And in hindsight, all I should have done in January, and I joke about this every year, is bought 3 times leverage S&P and gone back to bed. Because then I would have been up 75% on that one thing alone. Well, not gone back to bed, gone to Bali for a year. And I'll tell you this, I'll joke about it. Put it in your calendar. 2 years from now, message me, Alpesh, you idiot. Why didn't you just stick to the 3 times leverage S&P for the last 2 years and just not bother doing any of these broadcasts? Well, one of the reasons is, I think my wife might get a heart attack. Actually, she probably wouldn't. But it wouldn't be fun, would it, making money that easily? Okay, US market. This is just over 7 days, over 1 year. There's nothing much to say on this. I'm just telling you the top gainers over the last week since my last broadcast. That's all. We will go into some of these. I think we're going to talk about this one today. I think we're going to talk about this. I think we're going to talk about this. So we'll talk about some of these, some of the big gainers of the week. It's a 1 year outlook that we've got. So don't get too carried away about that. 7 day on UK. I'm sure some of you have got these things. HSBC I've covered on the BBC. I mentioned it, I think it was last year, and I said, well, when it's at this price, it tends to go up 100% within the, I think it was last year, it might be the year before. Anyway, it's on YouTube. And of course, it did exactly what I said it would, which was nice, especially when they're recording. Okay, year to date, energy seems to be the big riser. I don't care about the narrative. You might say the narrative is the Middle East. You might say the narrative is global GDP growth. More energy is needed. I don't care about the narrative. I need to see the data. Do not read anything into this. Way too early. And I don't care what sectors do, because I care what individual companies are doing. I have my Excel spreadsheet. I care what the individual companies are doing. Got it? I care what the individual companies are doing. None of these meet my criteria, by the way. I have very high standards. I have very high standards for stocks. You know why? Because my son and my wife will shoot me if I don't have high standards for the stocks I buy for them. And then everything else falls into place. When you realize you've got a gun to your head, you certainly focuses the mind. So I don't care for the top-down approach. I don't care for the articles in the newspapers and the magazines. And look, I've done my 3 years of TV shows on Bloomberg TV, so I know how this makes great content when you talk about energy sector and technology and communications and all of this, and how I care for the raw numbers of the individual companies instead, very much like Warren Buffett does. Markets over the past year, okay, NASDAQ's 23%, S&P. Now, if you've been following me every week, what do you know about my positions? I should probably do it as a test. You know I've got 3 times leverage S&P. You know more recently from November, I got 2 times leverage S&P, and you know I've got 3 times leverage NASDAQ. Now, of course, what I should have done is not even done a single commentary and just talked about those in January last year and said, bye-bye. Okay. But I've had those since the year before as well. And it's a very easy way to beat the index. I mean, it's really simple. If you think the index is going to go up, you just do the leverage of the ETFs and you've outperformed the index. So all these people on social media go, can you beat the index? Can you beat the index? Well, yeah. Anyway, that's too easy though, because I could just switch off now and say, oh, well, okay, see you guys. We're done. What I want to teach you is, look at this. You had all these gains and then you lost them all. So from January to May, you had a 0% return. Wait a minute. That's how a 23%. This is why people get it wrong and panic. How many of you have ever bought something, given up all hope, got out, and then it's raced away, never got back on, and oh, bloody hell, I've missed it. And then it's come back and you thought, oh, I don't know now. Probably got in there. Okay, happened again. Lost all those gains from then May until August. So most people from January to about August had next to nothing to show for it. And if you got in July, you had nothing to show for it from start of July to the end of the year, pretty much. Okay, but there to there, 12 months, 23%. The point being, the market can do one of 4 things. Either keep going up, which is what we love, happens only 25% of the time. The other 3 times goes up, comes down, goes sideways, or falls. 3 times it's doing, 3 times out of 4 it's doing something you don't want. 75% of the time it's doing something you don't want. That should tell you to be more patient when things are things look like they're going to go in your way. How do we work that out? Well, I look at value, growth, income, cash flow statement, profit and loss, and so on. This is the FTSE 350 over the last month. That's them. I'm not really going to talk about these. I know travel's been great because there's a limit to what we can talk about. Let's go to the S&P 500 more importantly. Now, I have said week in, week out, yes, it's overbought. The reason, by the way, just in case you want to know why we got out in 2022, and this is what differentiates us from all those funds that your pension or your work pension is in. They will never tell you to go into cash, because if they do, people like this, okay, if they do, they don't earn fees, neither does the IFA. So if you look at something like this over 3 years, what's the major problem you've got? Okay, well, for 2 of those 3 years, it got you a 0% return, and for most of the time, you were down 10%. Just look at that. From 2022 to 2024, January to January, you had no returns, and most of the time, you were down 10% at least. They only made their return last year in one of the biggest bull markets ever. Now, you might say, well, that's fine, at least they made it. Well, no, that's pretty bad, because 2023 was a brilliant year, and they missed out on that. The NASDAQ was up 55% in 2023, and they couldn't do it. Here's another problem, what funds like this often do, just so you know what fund managers are doing, okay? And this is one of the most popular ones. They take your money, Vanguard, or whoever, St. James's Place will be the intermediary sort of pimp for these guys, and then they shove it into a bunch of their other funds. So they take the main fund, charge you a fee. Well, first of all, the intermediary wealth manager charges you a fee, St. James's Place. Then they put it into Vanguard. Vanguard then charge you a fee. Then Vanguard put it into a Vanguard US equity fund, which charges the Vanguard fund a fee, which charges you a fee, right? So it's called fee layering. It's a problem, and it's a shitty little problem, and it means people get buggered up, okay, in terms of performance. They could do better. Now, you might say, well, I don't want to be making more money. I'm just happy with what I've got. That's fine. If I give you the alternative between, I don't know, 5% and 6%, you might say, which are piss poor. I mean, say a bank account. Let's say I had 2 bank accounts, 4% or 5%. You say, well, I'll take 4 because I don't want 5. Okay, that's fine. You're that unique kind of person who doesn't like money, and that's fine. Anyway, they'll never tell you to go into cash, which is a major problem. We knew to go into cash because we just look at average prices. Okay, it's just something I learned from the hedge fund industry. I've published it in my books for the last 30 odd years. Why those books were not, actually, in the UK, I reached number 2 on the international bestseller list when Trading Online came out. But it was only because I was on ITV at the exact same time. And I went home, checked on Amazon, and for 1 hour, 1 whole hour, I was number 2. Number 1 in 1997 when this, or 98 when the book came out, and this on the Amazon bestseller list. This is the UK list, by the way, not the US one, which is the real big one. Overall list. Number 1 was, in case you're wondering, was some geezer. I'd never bloody heard of him. I don't know who he was at the time anyway. It was somebody called Harry Potter. Anyway, don't know what happened to him. That was cash. Now, why is that important? That's important because if you hold cash, you've got firepower for here, and you make a lot more return. Mathematically, it makes a significant difference. So anyway, that's what happened. Now, why would we get back in? Well, because it stopped falling. It started rising. Very simple. Get back in, right? That's the most bullish projection. This is the base case. I'm going to give you other cases from the leading banks. And the bear case, I guess, would be this. I would only put a 20% probability on that. I'd probably put another 20% probability on that, and then 60 on somewhere up here, okay? And at the moment, I don't need to take action on my holdings on the S&P 500 because this isn't doing this. By the way, here's a little quick trick. If it's falling, it's called a mama bear, okay? I don't really need to take action. It can fall quite a lot though, 10%. Everyone else is throwing up, you're not. That's called a baby bear, when the prices fall, but this is still rising. Lots of babies, you can ignore your baby. Mamas, there's fewer mothers, but you can ignore them. Daddy bears, never ignore the daddy, okay? That's when you hold cash. Happens once in 7 years. but saves you a fortune. This is what the daily chart looks like on the S&P 500. I will answer your questions. Okay, Lake District, gorgeous. I was born and raised in Leeds, so not far from, well, it is a bit far from the Lake District, but not as far as London. These are the dailies. And I'd say daily-wise, well, given what's happened today, we may well have just hit a base here, okay? But what I'll say to you is, if it were to drop below this base, I mean, today it looks like it's jumped up, but if it were to break below, then I wouldn't panic, even if it dropped to another 300 points, okay? Because that would be typical, and that would be fine, okay? Because I've got a bit of perspective. But anyway, in the short term, we probably should get something of a bounce, because each time that's happened, look at that. Well, what's happened to the price? Each time that's happened, albeit that didn't, and then it moved up. That didn't for us because this was falling. So basically, if you can capture both of these rising, you're laughing and you're making a bit of a killing, as you can see there. All right. Something I teach my clients, there's a video for my clients today on that, but I told them don't start trading on it. Okay, I don't want to overly emphasize it. The NASDAQ 100, very similar story. Okay, so we're up 100% since January of 2023. So in the last 2 years, up 100%. And obviously 3-time leverage means it's up 300%. Was that going to continue? I don't know. Of course, I hope so. I don't have a conflict of interest with you. I'm not trying to sell you my brokerage services or buy into my fund at St. James's Place or whatever. So I don't have to talk bullish or bullshit, but I don't need to talk bullish to you. All I'll tell you is, if you look at that and you look at this, yes, we're keeping a close eye on it for that reason, that doesn't happen, in which case we've got to hold cash and just count our money, I guess, for a year. But at the moment, I don't need to exit my positions that I have in it. So now you know what my position is on this. But by the way, I've been telling people my position for donkeys. It's all on my YouTube videos. So those things are not a particular secret. FTSE 100 index, well, we'll see what happens. Is that going to bounce off? We seem to have something of a support, which may well hold, but it goes sideways for bloody ages. I mean, it's not far from when it was in 2019. I love the FTSE because it makes me feel young. It's the same as when I was in my 40s. 2 times leverage, S&P. Now, don't do leverage, okay? I do leverage, and from 2023, obviously from 10,000 to 25,000 has been a nice little return, and I continue holding that position. Yes, I can see that could drop, but then again, you need a strong constitution to do leverage. Basically, S&P goes up 10%, I make 20, but it goes down 10, I lose 20. Okay. These are the top 10 stocks over the past month. Let's look at some of these. I'm not going to look at all of these. Let's look at some of these. Okay. This one is Walgreen Boots. I mean, bloody hell, Boots. 53 all the way down to 9. Decimated, absolutely destroyed. Look at how you can destroy great name. I mean, Walgreens is a huge name in the US. I really like Walgreens stores out there. They have everything. I just love walking around these American stores. Boots, okay, looks like it's got a bit of a bottom. Looks like it's got a bit of a base broken out from a downward trend. If you were doing this, and this isn't as part of the Great Investments Program, because whilst it's a 7, if you were doing this, you would probably aim for that kind of a return. You'd probably put a stop loss where here, because if it's going to do this, it shouldn't drop below that low. And that means your reward is at least twice your risk. Done. But that's not a recommendation for you to do it for a very simple reason. I don't know if you're a 90-year-old widow on her last £1,000. Obviously not individual advice. Okay, but that's how I'd structure it. Okay, on that one, I'd make sure the amount of money is that were that loss to happen, that drop to happen, I didn't lose more than 1% of the total value of my portfolio. That's how I'd do it. Okay, Nova, I'll show you another one. That's the direction, I guess, if it were to continue in there. We don't know if it's going to. I know some of the banks like it, don't care. I'd probably put a stop loss there and put that as the gain. Multiple upside to downside seems to be really popular. Okay, and again, it's had a great month. Coterra Energy, not part of the program. It's not 7, 8, or 9. But if you were looking at that kind of a direction up there, then you'd probably put a stop there. And that's your direction there. Maybe even a stop just even here, because it shouldn't go below that line. So keeps it simple. and then you're looking for those kind of gains. Basically, if you don't think those gains are realistic, you wouldn't even go near it. If you don't like that kind of volatility and these kind of drawdowns, you don't. That's what we help clients work out. What's bespoke volatility for them? What's the kind of gain that they're looking for? And is that gain realistic or not? This is just an overall example of the ones there. I don't own Bank of America, but as you know, every single week I do an update on it. Okay. Sana, I'm going to talk about when to take profits in just a second, because guess what? I had so many people asking that question. So I will answer all these questions, marks and so on, but I will actually talk about when to take profits in a second, because obviously a lot of people have got that issue. So Bank of America I don't own, and maybe in hindsight I should, but I've been covering it since it was about here each week in these broadcasts, as you will know, just to give you that market update of where are we on the broader market. Okay. As well. And okay. Sorry, I just got a message from Paresh about something. Thank you. He's taking care of some data. We're putting together data which looks at all the shares which outperformed the S&P last year, so rose, say, 25% and above. All the ones which went up at least 150% over the last 5 years, so it wasn't a one-hit wonder. All the ones which went up in 2022 as well, when the market went down, and then a few other statistics in terms of volatility to make sure they've got less volatility than 10%. So they're not very volatile. They've got that consistency. And out of about 10,000, we're left with, I think it's about 100 or 200. So he's just sorting out the data for me on that. And so he's just, messaged me on that at the moment. Because he knows I want to get that data correct. And there was a few tweaks we needed to do. Right. So still all fine with the banks, Netflix. Well, again, as you know, I don't own, but I've covered it ever since it stopped this fall and had this big day up. I think it had subscriber numbers back there. And in hindsight, I guess I wish I did buy it, but I can't buy everything else. And I've said to you every single week since then, so for well over a year, that it continues looking good. I'm not saying it's going to do this, by the way, okay, because when it drops, it will do this. That's why, this whole notion of, okay, just buy and hold forever. No, there's next to nothing you'd want to buy and hold forever, because it's snakes and ladders. Why would you want to climb the ladder, get your gains, and then just sit there like a muppet, take this loss, and then have to, lose three? That's what fund managers do to you and your pension. Okay. This is by the way, in a fund, this is the period when you advertise and market the fund right up to here until people notice that, you're really bad. And then you start again the marketing this bit, only talking about that bit. Okay, that's what fund managers do. In case you haven't realized it, I hope you have realized it. Okay, so for us, FX all fine, but we'll keep a close eye on the momentum. Wait a minute, Alpesh, aren't you keeping a close eye on subscriber numbers and content and quality of content and getting a PhD in it? No, how can I do that with 10,000 companies? You can't. I'm not going to do a narrative story on 10,000 odd companies. What I'm rather going to do is say I want all of these boxes to be green. First sifting, data, not narrative. Because you know what data is generally? Far less biased than humans. Okay, and narratives and stories. Stories are great if you're a fund manager or a wealth manager. You speak to the wealth manager. They won't show you the data. Well, they'll show you if it favors them. What they'll do instead, right, is they'll yak on about, well, this fund manager went to the right university. No, he knows what he's doing and all the rest of it. They'll love to talk about all of that, blah, 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 because that's what sells. Since when did people ever sell on dry data? But dry data is what you should be really looking at. Okay. Eli Lilly is one of those which, again, I don't want to buy and hold forever. And at the moment, with momentum there, although it should perk up a bit, with momentum there, it's not one I'd buy today, but it is one which we keep an eye on, because you get prolonged periods of wonderful little gains where you get to triple your money. But you can't just buy and hold it forever, because you also get, like this period, well, certainly this period, you get falls. So we want to keep a look at the momentum, and only when it's a 7, 8, or 9 on our value growth income criteria would I want to get back in to it. I don't care what the banks say. They tend to be over optimistic, and the academic research proves it. I've written 18 books on investing published by the FT and Macmillan, and in that I've taken research from academics, especially Eugene Famer, Daniel Kahneman, Richard Thaler, all three of whom have won the Nobel Prize in economics. I've even given given 2 TEDx talks on their work and lectured on it at Oxford University. So I just I stole from the best, basically. I'm not clever enough to be like any of them. So I just take all their work and say, right, wait a minute, why don't we look for undervalued companies with high growth, dividend deals, and do what they said works? Why wouldn't I? Okay. It's simple. I didn't invent any of this. I didn't invent any of what I'm telling you. It was all taken from the best bits of academia, think tanks, Goldman Sachs, and I'll show you some of the slides that were stole from Goldman Sachs as well on this. There will be opportunities. This is for the Great Investments Program, so I'm not going to sort of reveal too much here. There will be opportunities continuing. Don't be put off by what's happening with the markets. And the reason I think there'll continue to be opportunities, but I think there'll be fewer than there were last year, and I think we'll need to keep a closer eye, and I think there'll be a bit more volatility than last year, is because the bull market's gone on for 2 years. However, research shows that it tends to go on a bit more. So if we get an up year in 2025, then probably 2026 would be the one I'd really be worried about, okay? But it looks like it's got legs because it tends to have legs. 2.1 years current bull run. This is the current bull market, okay? This was 12.3 years up to March 2000. This was 11 years up to Feb 2020. That's the 1987 crash, 5 years, 6.2, 5 years. The current one is only 2.1 years in, so it's well below average. That's not a reason to get over optimistic. And the reason it's not to get over optimistic is because we want to be objective. I'm not your IFA who's going to sell you some rubbish fund and say, no, look, it's going to go, give me your money, give me your money. If you're not comfortable, don't even be in the market. Risk loving, 100% equities. Risk averse, 100% cash. In between, a mixture of exchange traded funds, which are baskets of assets. Your IFA won't sell you ETFs because they don't earn any fees off them, so they'll never sell you them. It's as simple as that. Okay, well, they might sell you 1 or 2, so they can then say to me, "Look, I told you I'd sell you 1 or 2." Quantum computing one asked me, "These are the main companies to look out for. Just look at the Bitcoin-like volatility." The interesting thing now is, so they've had their excitement, they've dropped back. I would say all of these 4, on average, will probably go back to where they were. But the only problem is how long. A bit like Bitcoin, God knows, could be 10 years, could be 1 year. But it's worth keeping an eye on these. And for my clients, I'm keeping an eye on Rigetti, D-Wave Quantum. Actually, all of these, I'm keeping an eye on for my clients on this. Okay. Gold, my wife bought some gold. My wife knows nothing about investing. She doesn't care about investing. First time she's ever done anything. Interestingly, a whole bunch of other gold, listen, I treat it like any other security. So I'm not a gold expert by any means. But I just thought I'd say, now, my wife buying gold, if gold crashes, then obviously it means that I'm going to put a whole bunch of other stocks and securities in front of her, and anything she picks, I'm going to short. If gold continues rallying, then I'm going to do the same, and anything she picks, I'm going to say, I'm retired, you take care of it, sweetheart. Okay, but I just thought I'd share the forecasts with you. JP Morgan, everybody seems to be saying it's going to go up. So there we go. Fund Manager Survey, thought this would be interesting. Best performing asset class. Which of the following do you expect to be best performing? US equities, 30% of the fund managers said this, global equities, and so on. This is from UBS, Bank of America. Okay, Bank of America, UBS. So don't read too much into it. Don't read too much into it. Okay, they don't favor bonds. No shit. They're selling UK government debt, which is why yields have gone up. So when the government says, I think they had an auction today, actually, I might be wrong, I didn't look. When the government says, the British government says, we need to borrow $10 billion, and the people come along, the big institutions, pension funds come along, fund managers come along, and they go, well, you're going to have to give me 5% interest, or 6%, or 7%. And so the government, the way it does it is it reduces the price of the bond it's selling at. Don't worry about the internal mechanics. So people are asking for a higher interest from the government. It's a bit like if, somebody asked you to lend them money. If you didn't think they were a good credit risk, you might say, well, I want a really high interest rate. It's not the only reason they're falling. It's happening around the world. But anyway, that's where we are with that. Best performing equity index, fund manager survey, they think the Russell 2000, that's the smaller US companies. Then you've got NASDAQ, MSCI, emerging markets, Hang Seng, Euro stocks, Nikkei, the Japanese market. That's what they think. Doesn't mean it's going to happen. All right, doesn't mean it's going to happen. I've got ample choice. I've got 10,000 stocks. If I just look at the UK stock market and the US, okay, and all the exchange traded funds, add another 7,000. So I've got 17,000 securities to narrow down my holdings of 20 to 40 securities into. This is the Dow in 2024. These are the companies which generate the most points. Now, declaration of interest, I do own Goldman Sachs throughout all of last year, you'll know, and I'm going to come to it in a second. I said to you I'm holding Goldman's and continue to do so. So that was that one. What were the worst performers? Well, Intel, surprisingly, pretty bad. United Health Group lost their NVIDIA Dow point contribution minus 70. That's because it joined the Dow late. So don't read too much into it. I know it had a great stonking year, but it joined the Dow late. The Dow is 30 companies, and it's not based on market capitalization. It's based on a committee which decides who represents the United States. So what's going to happen this year? Well, that's what we'll keep an eye on. And in that sits my son's inheritance. I mean, I could limit it to just that instead of 17,000 securities. Sits fortunes to be made by lots of Americans and some Brits who are clever enough to invest in US stocks. I wrote my first Financial Times column in 1999. In the first paragraph, and I'll show you it later, I'm selling all my UK holdings and buying US ones. That was 1999. It's because I had more choice. It wasn't because I foresaw the rise of AI. I didn't. I just thought I'd show you this out of interest. Companies by revenue, total revenue. Fortune Global 500 companies, the annual rankings list, world's largest companies by revenue. I didn't know that. I didn't know it was Walmart. Okay, I didn't know it was Amazon. I didn't even know. I still don't know who State Grid are. Okay, Saudi Aramco, of course, and then I don't even know who that is. CNBC, the Chinese petrochemicals company. You've got Apple, United Health, Berkshire Hathaway. CVS has had a stonkingly bad year. Been bloody awful, but it seems to have bottomed and it's been going. But anyway, I just thought I'd show that out of interest. One of the things that I like about having 17,000 securities to pick from, it also gives me the comfort of picking names which, basically, the Warren Buffett test. If somebody switched the market off tomorrow, would I be happy holding on to this? And that's a pretty good test with a stock. Okay. Also, sack your IFA if they can't do this. If your IFA can't, I mean, look, over the last 100 years, I'm sure you're not any of you are 100 years old, but you get the point, pro rata. 30% of the time, the S&P rose over 20%. So if 30% of the time you've been with your IFA, your performance hasn't been 20% or more, sack them. 10 to 20%, 24% of the time. So a majority of the time you made over 10%. So if you haven't made more than 10%, a majority of the time your funds have been with the IFA, sack them. Pretty good rule of thumb. My job, people think, is to do this bit. Well, it's not. The market does that for me. My job is actually to make sure I hear the mood music and to go into cash on these occasions. Even forget the minus 0 to minus 10%. Actually, really on these 20 occasions out of 100. 1 in 5. Remember earlier I said once in 5 to 7 years the market drops, the significant drops. 1 to 5 to 7 years historically has been it. So 1 in 5 to 7 years. I've just, like 2022, I've got to say to my guys, hold cash this year, and it saves you a fortune. People think money's made by picking the right stocks. It's not. The fact of the matter is the market has a tailwind most of the time. Money's actually made by leaving the right stocks alone, i.e. once you've got them, don't bloody touch them. And the right stocks might even be the index because you've got a tailwind. Most people, they panic at the first dip and then it soars and they're left sitting by the train station watching the train go and thinking, oh no, it'll pull back, it'll come back and collect me again. I've got off the train, and it won't. It just keeps going and they go, oh, bloody hell, I've missed it. Okay, that's most people's experience. My job is just to make sure really it's this bit to avoid that. Because this bit's done by the rest of the market. It's done by very clever people running very big companies. Not by me. I don't run a very big, clever company. I just ride their coattails and buy stock. My job is to spot clever people and avoid big drops. And even if they're not clever people, the tide's rising most of the time. Here's another interesting thing I want to show you. So over the past year, these funds, these happen to be investments. They're not ETFs. They're unit trusts. I'm not recommending any of these, and I'll tell you why. Total return over 3 years, not bad. Over the past year, not bad. In a down market, not bad. However, so we're doing this kind of analysis, but we've got a whole load of non-price related things coming up, and we're using exchange traded funds because they're a lot cheaper and you get more choice. Now, looking at that, do you really think I'm going to go into Turkey this year? No, because historic data, even if history were to repeat itself, you might lack the confidence, which I would, to say, oh, let me go buy Turkey as a result of this. It'll be a diversifier. Well, no, if the market's going up, I certainly don't want to diversify because it would imply something going down. And if the market's going down, then a diversifier implies something going up. Well, actually, when the market falls, correlation increases to the downside. So it's hard to find diversification. So don't fall for that whole load of rubbish. Watch out for these funds. Watch out for these issuers, Fidelity 91, Bailey Gifford, St. James's Place, because compared to their benchmark, now their benchmarks, okay, here's the interesting thing. Their benchmarks are replicated in exchange traded funds. So if you just found their bloody benchmark, by the way, I would not be happy with just a 33% return over 3 years when the market's been bloody having one of its best moves ever. But nevertheless, if you just followed their benchmarks, you'd be a hell of a lot better than following them. It's a good way to cheat. Okay. They'll all have benchmarks. This will have a benchmark as well. I'd rather not be in that for the reasons I said. Goes bloody nowhere. In one of the biggest bull markets, 2023 goes nowhere, gets its returns in just 1 year because eventually they worked out, and gives all its fees, charges you fees for selling to itself. Isn't it interesting? Vanguard fund invests only in other Vanguard funds. Restrictive practices, anyone? If Apple did that, they'd say, no, that's a closed shop. Should they not be picking from the best of what's available everywhere? They don't do it. Look, that's their holdings. There you go. Do you not think they should do that? Value to you and your clients too. Look who they're writing to, and your clients too. Professional investors only. All right? It's a scam. I mean, I used to use polite terms for it, but it's all become such a scam. Akram has been shorting. Well done, you. You're a brave man to either be shorting them or, I guess, going long in them at the moment. It's so much like Bitcoin, isn't it? These are the worst culprits. Because institutionally, it's not that they're fraudsters. It's just that institutionally, the reason they underperform so much, so be careful if your pension's in these, okay? The reason they underperform so much is because, first of all, they'll never tell you to hold cash. Secondly, they spray and pray because they've got so much capital. They have to divide it amongst so many different entities. And thirdly, they want to pay themselves twice. And the way they hide higher fees, the best way to hide higher fees is this. You say you've got one fund, right, like this, and you charge fees, and you only discuss your top level fees, okay? So you say whatever your top level fees are, right? What you don't say is you're going to get a bunch of other charges which are under there, which also are coming back to us in our company, in their own company. They're sort of self-feeding. Parliament will get around to it, I guess. Eventually they'll work out what's going on, but it should be banned. Anyway, the practice goes on. They're not the only ones. They all do it. They all do it. All right. There's a reason why. Somebody asked me for career advice right now. I said, go into finance. You're going to make bucket loads of money. It's where the money's at. I would not say to them, hey, get a pension. Well, I would say get a pension, but I wouldn't say, hey, just get a pension. I'd say, got the choice, go into bloody finance. Because I'm afraid you'll be joining the rip-off culture, but that's how it is. So can't go into cash. Narrow group of equities they invest in. That's why because they've got so much money, they'll only give in Asia or, or Japan or whatever it is. Okay, so it's a common problem. It's been done. Lessons going into 2025, you've really got to keep an eye on. Earnings, as long as profits are going up. So watch my weekly broadcast and I'll do it for you. Do I know anything about PWM Solutions Wealth Management? I do. Send me across any of their funds if you wish. I'll look at it and they'll have the same problems. Ask them how they did in 2022. Ask them why they underperformed their benchmark for so long, and ask them why their performance is so poor compared to just an S&P 500 index tracker. Okay, those three things. And every single time there'll be a lot of awkward silences and ums and ahs and ums and ahs. Okay, and then ask them, show me what your fund's investing in, right? And one of two things happens. Either it'll be a bunch of stocks you could have just bought yourself anyway, because they have to disclose what they invest in, or it'll be other funds of their own. Boom, that's them done. That's why I believe in SIPs and ISAs, and I'm glad the government created those vehicles, because from when I wrote my first book to my TV shows to my Bloomberg TV stuff to my FT, my goal has been to make sure people knew how to invest themselves. I didn't invent that. I didn't tell people to invest themselves. Other people have been telling people for years. I just came along lately to the party and said, hey, you really need to do this yourself. So I'm going to keep an eye on these things for you, as long as those rise. Now, the reason I say that is when the dot-com bubble happened, and I was doing my TV show on Bloomberg at that time, we were living through it. And I said back then what I'm telling you now. Yes, as long as the earnings are there, and they weren't there, we're okay. If earnings aren't there, then it's a bandwagon of momentum. And like all bandwagons, it's going to fall off a cliff. Nothing wrong with riding a bandwagon. I wish I could get that clip, because I used to say it week in, week out. And you just got to jump off before it jumps off a cliff. So at the moment, earnings are rising. We're okay. So you're okay at the moment. But eternal vigilance. They're going to come after your pension, because that's where the money's at. I'll tell you one thing I'm going to guarantee you, and I don't guarantee much. The gap between the NASDAQ and the S&P and the UK market, which is this one, okay, that's the UK in black, hard to see, that gap's going to get wider. So over the last, 2025 to 2015, 10 years, it is over 350% in return is the difference. The Brits got about 41% in 10 years. And that's what your iPhone wealth manager is going to try and get you to focus on. And NASDAQ's got 417. Even if you don't do that, you got 200. You got 200 just from that tracker. Let alone if you were a client of mine and stayed in cash in that period. Okay, right. So, or like my 10% of my students who like to do the leverage bit and got significantly more. Right. So, what does that mean? Well, that gap's getting wider. The British people who are so reliant of their wealth being in their pensions are not just going to get screwed by inheritance tax and all those pension things that are happening now to farmers and everyone else. They're going to get screwed by underperformance, the invisible tax, the tax of ignorance, the tax of fund managers in this country. Okay, we're going to get poorer for that reason. They are destroying national wealth. Yeah, I know. Something should be done about it, shouldn't it? Okay. And why do I think that gap's going to get bigger? Well, just look at the two governments and directions they're going in. So this is our goal. It won't always happen. I've managed to grow by 65% over 2 years with the help of the program. That's not going to happen every year. It's been 2 good years. There's been a nice tailwind. Okay. That's good. I'm happy. But I also know there'll be years when you're just sitting there holding cash, like 2022. Yeah. And the price of success like that is eternal vigilance. We've got to keep a close eye on the markets. This is an article from the Daily Mail. Please watch out if you've got a pension, a worker's pension, default pension. Biggest default pension has all lost value this year. Be very, very careful. I've done a video on this and many other issues on my YouTube channel of all these various pensions. I'm not a fan of pension funds for obvious reasons. I mean, you can see them here. Give workers power to ditch pension schemes. That's the Financial Times. That's the UK regulator calling for a reform. It isn't me. It isn't a guy saying, hey, you should do this. Buy my book. Actually, you don't need to buy my book. I'll give you a copy of the book. I'm going to do it now. Actually, I'll do more than that. Let's start off with, let's publish some polls and give you the book, Investing Unplugged, if you haven't read it. That was published by Macmillan. Palgrave Macmillan, and it's from my time when I was at Bloomberg TV, and it gives you the whole, everything that I've said, it gives you the academic background behind it and the research which proves it as well. And it's got wonderful reviews from hedge fund managers, Bloomberg TV, BBC, Financial Times on there, so you'll see that. Okay, that's what worries me. This worries me. Why do those retiring face massive losses despite FTSE highs? Well, because gilts. Aviva Pension, amongst others, put a bunch of money in bonds. Okay, price of bonds fell because people said, well, we want lots of interest to lend to the British government. So the price of bonds fell, so the pension value fell. Yes, the yields went up for people buying those bonds at that cut price, but that's too late for you guys. So guess what happened? 20% loss. Hang on, but pensions are supposed to be safe. Aviva's supposed to be safe. These people are supposed to know what they're doing. I'm not saying this. The Guardian is telling you this. And guess when this was from? It's more than 11 months. Guess when it was from? Liz Truss. Guess what's happening now? Bonds have gone up. Yields have gone up. Bonds have gone down. All I'd say is if you're of a nervous disposition, maybe don't call up your provider and ask them how it's going. Telegraph, British fund managers become pointless expense for investors. Worst fund managers take $500 million in fees from investors. I can tell you their kids are going to private school and you're paying for it. So I want people to be self-educated. That's why SIPs and ISAs were created. So people learn themselves. If nothing else, if you say, I don't want to do it myself, Alpesh. Okay, I don't want to do all of this, even if you've got the data, that's fine. At least be better armed to ask the person who's your wealth manager or IFA the questions. Okay, because if you don't even do that, and that's your future. So the minimum thing I'm asking of you, just do that. Okay, I've got a ton of free resources for you anyway. Wait a minute, I want to do this poll now. I want to do this, but still lots to go. By the way, FTSE high, you're 50-50 on this. I'm going to end that poll. Let's now ask you the next. How do I move polls? Oh, reset poll. Here we go. What about the Dow then by the end of 2025? There we go. Okay. This is the one people asked about in terms of profits. I'll come to that in just a second. Investors rush into US equities. I'm not the only one saying it. I mean, flipping heck. Billions, monthly net flows into US equity funds. Flipping heck. Okay. If you're not relaxed, you put too much money into a particular stock, you don't have the data and you don't have the know-how. So if ever you get panicked by the movements, obviously when things move up, nobody's ever panicked. It's when it drops. That's when you know. So let's have a look at that. You should be this relaxed. Watch his film, The Big Short. Brilliant. That's me doing the impersonation, right? With my son, I take that principle. I've got to be relaxed. So these are not what he holds at the moment, by the way. He still does have that. And this, he doesn't have Globant at the moment, but there might come a time when he has it. This was just for then and doesn't have it now. All right. With his junior ISA, so we're going back a bit. With his junior ISA, and that's when you could only put 4K in, I think 2018. Now they've increased it to about 12-ish. I don't put in the same stocks I've got for mine. The reason is, unlike what people say, oh, he's young, 6 at the moment, you can take higher risks, shove them into main stocks or venture capital trusts. No, don't be stupid. I'd have a guilt complex if I didn't give him something. 2 things I want. Relatively safe that I'm confident of. In fact, you know what? I should have had in my portfolio what I put into his because the rules I had for him and my wife were so high, it had to be stuff I could leverage. And I felt confident enough. In other words, low volatility downside. So all the stuff that I've told you about already, my Apple, Amazon, Alphabet, S&P, NASDAQ, he has in his. And the reason was I want to keep it simple. I don't want to keep looking at it. And I want to make sure that if I take risk, I give him more risk, it's going to be in those lower volatility ones that I don't need to keep exiting in and out and keep watching. So I don't treat it the same way I treat mine, although I'm starting to think I should just treat mine the same as his because I have a high standard for his. Anyway, this is another student, joined in 2021, got deep into investing about 15 months ago and got 60%. Now that's because there was a market tailwind. How do you deliver those results? One, there's a market tailwind. That helps, obviously. Okay, and secondly, you make sure the person's got the data, and then you make sure that the only thing they've got to pick is the volatility levels. Keep it under 10% volatility if you're risk averse, under 20% if you're more moderate risk. Okay, so simple as that. Everything I've told you, I've published in the Financial Times. Every single thing I have told you, I have already published in the FT. Okay, and in my books. So it is been tested and been put out there for a long time. This is somebody who, I love this student because he joined in 2021, put 100K in, got to 400K, and didn't message me for 3 years because he's busy having babies, which is lovely, especially when they've got babies. And of course, that takes 2022 in there as well, which was a down year to hold cash. But it's let's be absolutely clear, it's not me doing it. It's 2 things that are doing it. The great companies on whose tailcoats we ride, having access to the data and knowing to look for undervalued companies, and this isn't original, undervalued companies that are growing with good cash flow, high Sortinos, high alphas. Oh, here's another question to ask your IFA. What's the Sortino on the funds you want to put me into? They won't know what the hell it is. It's well known in the hedge fund industry. They won't know. They might talk about Sharpe ratio. They probably won't even know that. Okay, the level of ignorance amongst IFAs is shocking. I mean, they are useful for some things, like how much money to withdraw so that you've got enough by the end. I mean, basically, they go to an online calculator. The software's provided to them. And they go, oh, if you take this much out, I mean, it's like your bank manager saying, this is your interest rate, that's how much money you'll have at the end. And they go, pat me on the back and pay me some money for that. Cash, don't forget. And the reason is this. Dow 30 companies, this is a few years ago when I did this. Okay, in the last crash of 2008, so I'm going beyond 2022. Okay, to show people why you had to hold cash in 2022. I said to them, if you look at the Dow, okay, just the Dow 30 companies in 2008, there wasn't anything to be held. Look, they all fell. So this notion of diversification, well, wait a minute. Why does Boeing and Intel both fall? What the hell? And I wouldn't have had the balls to buy Walmart, just about the only company alongside Amgen and McDonald's, which rose. If everything else is falling, I'm not going to think, oh, yeah, I'll buy those. Oh, it's okay. My umbrella will. I can walk between the raindrops. No, you have to hold cash, and that was my argument to my clients in 2022. Let's just wait until February's list. We do the list each month. See if there's anything interesting buying. There wasn't. March, April, May, June. For this very simple reason that I said to them, don't buy something for the sake of it, because everything can fall. And indeed, in 2022, this is what it looked like. Out of every 30 stocks, 27 fell. Okay? And that's what saves you from the big drops. And that's my job as well. So actually, that's the most important job, I'd say, of all the jobs. It's not picking the upside, because the markets rise more often than they fall. It's this, staying out, because on that side, everybody else is bloody quiet. Certainly your IFA is going to be quiet, because if you go into cash, they can't charge you money. They don't earn fees, and they've got school fees to pay. Big gains if it drops X, sell Y. Now, that's a big lesson. Somebody had asked earlier. I'm just Sana. I'm answering it here. So I got contact with one of my students. He said, look, I'm up over 30%. What do I do in terms of, I think this is the one where he said that. If it drops X%, sell Y. In other words, let's say NVIDIA. For your risk appetite, well, I don't know what's going to happen in the future with NVIDIA. We can make lots of guesses, and you're probably right to say it's going to go up another tenfold. I'm sure you're right. But if it drops 10%, how much do you want to sell? You might say none. If it drops 20, how much do you want to sell? You might still say none. If it drops 30, how much? You might say none. 40, you might say, well, I think I'll sell 10% or 20 or 30 or 40 or 50 based on your risk appetite. So 10, 20, 30, 40, put the numbers together. Okay? Now, you'd be stupid to say, well, if it drops 90, I'm still going to hold it. It's a bit much, isn't it? If it drops 10%, I'm going to sell it. Well, that's a bit crazy. That's hardly moved. It can do that in a couple of days. Okay, so you've got to balance it. Oh, XRP, just for anybody who's interested, I own Ripple and I own Dogecoin and a bit of Bitcoin. Nothing to write about, because the bloody things are only up I mean, I've had them for 5 years or more, 6, 7, 8. They've been underwater the whole time. I am not a crypto expert. All right. By any means. I bought them in the way somebody might buy some stamps, and there's nothing about stamps or modern art. And recently they've done well, but I won't look at it for another 10 years. Okay. Oh, this was it. Yeah. This is your question, Sana. One of my students was asking me. So there's the answer. If it drops X, sell Y. And you'll have heard me on social media talk about that time and time again. Follow the process, check all the boxes, remove chance. For us, it's value, growth. If you are, whatever approach you're taking, if you are focused on narratives and stories, you're in trouble, because you're being sold to. Okay. And Warren Buffett says the same. It's why he doesn't meet company directors before you invest in a company. He says, what they're going to tell me other than that they're wonderful. If you're not looking at valuation, i.e. how much you're paying for profits, you got a problem. If you're not looking at growth, you got a problem. If you're not looking at dividend yields, of these three, that's the most important. Then this, then this. If you're not looking at cash return on capital invested, that comes from Goldman Sachs Wealth Management. It's okay if you're not, but ideally you should look at some kind of measure that they're generating strong cash. Crashes in stock markets come from three things. What do company accounts have? They have three things: P&L, balance sheet, cash flow. Crashes come from three things. P&L, i.e. lack of earnings, dot-com bubble. Balance sheet, sorry, excuse my finger. Balance sheet, lack of assets, financial crisis, 2008. Houses weren't worth what they were told they were worth. Okay, second type of crash. Third, cash flow, COVID. Okay, close the shops, no cash coming in, crash. Three things they come from, right? And that's why we want those three things for each individual company to be strong and green. And Sortino and Alpha is the bit that I cheat on. Consistent high returns, low downside. For those who then say, well, is that guaranteed to work? No, nothing is guaranteed to work. If you think something's missing, do let me know, and I'll let the Nobel Prize winner, Eugene Fama, know, hey, mate, you're not as clever as you thought. Okay, this is from Goldman Sachs Wealth Management, and I think I stole from them. Years to retirement, you might say 25 years, in which case you can have lots of equities. Fixed income, I use Flagstone to then put money into different bank accounts. I get it on those bank accounts get me about 4.5%, I think, at the moment, interest. If I want it, I think 10% of my cash is in that. The rest is in stocks. Okay. Normally, I want 20 to 40 stocks. An interesting thing we found when we filtered our stock picks, what we discovered is that if we picked a random group of 40 from our filtered list, so what we do is we filter it, we give our clients this, and then we filter it. Okay, this isn't the filtered version. These are ones we wouldn't buy. Okay, if we filter it and we just picked a random 40, we got pretty much the same performance as if we picked a random 20 from the filtered list. Now, normally it should be more performance for fewer stocks, but I guess if you pick a random measure. Anyway, my point is I won't pick more than 40 because you're not removing company-specific risk. Market risk can only be done in 2022 by holding something outside the market like cash. All right? So your IFA will try to convince you that by diversification into different stock market stocks like emerging markets or China, you can reduce market risk. You can't, and they're an idiot. You can only remove market risk by not being in the bloody market. Okay. Again, published all of this. Paresh and I wrote this as book number 17 or 18. My book's got thinner over the years, and that's the book launch, which Barclays kindly hosted. Tons of free resources there. Speaking of which, and before I answer questions, and I've got a bit more to go, most of you think the Dow will be up. That's nice to know. I better short it because retail clients tend to be wrong. Here we go, publish another one. Yeah, so links, lots of free resources on there. I don't have a monopoly on ideas, so what I tend to do is also filter by hedge funds who've got over 40% return for the last for the last 3 years. So if they keep getting over 40% per annum, 3 years annualized, okay. Now look at that, right? You look at that performance, 2016 to 472%, and you compare that, even over a short time with Muppets like this. It's not like to like, I know, but money's money. Bit of a difference. Yeah, I know they had a period where they went sideways, but bloody hell, when they go up, they don't go up 40%, right? They pretty much double your money when they go up, okay? There's a big difference there. So what we tend to do is also see what do they own and see if it meets our filters so we can double check our work. Because I'm not so arrogant as to think, oh, only I know all the answers. And we'll look at hedge fund data. This is a historic document to show you what kind of stuff we look at. We'll look at what securities they're adding and they're dropping and see how that cross refers with our list to make sure if something doubles up, like they've got it, we've got it, then we think, let's go with that as a tiebreaker. And these are the various hedge funds we'll look at as well, and others actually. Now that list has been upped to see which ones are generating more for us and are they getting it. And by the way, of those, very few, there's about 3 that do 40% per annum for the last 3 years. This is old, so don't go into this now. But that's when we look at this and then we say, well, what's in our filtered list? Oh, okay, then we'll get it as well. And I think at that time, The ones which were also in our list were these: Amazon, Microsoft, Shopify, MasterCard, Visa, Fiserv, ServiceNow. They're not now. This is old. Okay, and anybody who's been following me, I'm not breaking secrets for my clients, but you know I already own Amazon and Microsoft. And I think we've still got MasterCard, but I can't remember if it's MasterCard and Visa or just MasterCard. And in the past, we have ServiceNow. In the future, I'm sure it'll come up again as well. Very important lesson, which I've mentioned to you, is the daddy bear rule, which I showed you earlier, so I won't do it. Okay, I won't do the daddy bear rule for you again because I showed you earlier, but I'll go on to. And as you know, I leverage on low risk. We look to see which ones, whether it's a CFD or an ETF, which ones have over 20 days less than 29. I mean, we'd really want it to be about 0%. If we can get very few stocks have that. Statistical measures, which are over 5 days and so on, will have dropped maybe 10% max. Okay, and over 250 days have to be positive. This is statistics. So it makes certain assumptions on stock price moves. It looks at historic stock price moves and then projects forward what the range of possibilities are. So it's not guaranteed, but where we see that it's skewed to the right and the numbers are quite high probabilities to the right. So ideally it looks like, oops, I can't draw this. It looks like this rather than something which, you know, is heavy down here, which you'd want to avoid. So it just gives us a bit of safety, as well as all of this. It just all gives us a lot of safety. Okay, and the prize is this: how long does it take to double money? Okay, if you're getting, as your IFA will tell you, 5 to 7%, given that the bank's giving me 4.5%, it's going to take you 10 to 15 years to double your pension, which I'm sorry, for most people, it's like, sorry, mate, I needed to retire well before then. We want to be down here. Now, if we target projections of stocks where we look at the trend and see that going forward, and that gives us at least 40%, we're not going to get 40% every single year. Obviously, what's going to happen is if we even get a 20-year or a 19 or an 18 or a 17 or 16 or 15, we're more than happy, because then we can double it in under 5 years. And ideally, I'd want to double it in 3 years if I can. There'll be some years where it will blow the doors off, like last year, not because of me, because the bloody market went up 25%. And the year before, where the NASDAQ went up 55%. That'll make up for my 2022 type years. Okay? I can't get big years every year because the market doesn't deliver them. And I don't have the balls to buy the 3 stocks that went up out of 30 in a down year. I just have to hold cash in those years and wait for the bigger ones. Okay, and that's what happens. So we want to be playing down here. St. James's Place will happily have you getting your 4 and 5% and waiting that long. They're stealing your future. So what do I think is happening over the next 2 years? I've said it before. I'm just going to go with statistics. I'm going to cheat. I'm going to get 32% over the next 2 years. Now, I hope to get more. I expect to get more. Because 88.5% of the time over 2 years, 32% is the norm. Actually, my son, who has quite a bit of triple leverage S&P, will get 100% over 2 years if that theory still holds. So he'll double his money sooner. He's young. He'll have to lend it to his dad. Okay. We've got a bit more coming on. We've got a bit more. So you said the main reasons you don't like these underperformance, always the case. Lack of communication is worrying. I mean, why aren't they doing webinars at 9:45 on a weekday? Why is your IFA wealth manager not doing webinars right now and communicating with you every single week? Fees, I agree. I hate subscription. I hate annual, weekly fees. Not trustworthy. Yeah, well, they're ignorant. They're stupid for a start. Underperformance is the biggest one that always comes about. The underperformance, as I said, happens because they keep selling their own funds to themselves. So they've got layers of fees, but on top of that, they spray and pray. They can't hold cash, and they put too little in each individual thing in the name of safety and less volatility. But all of that results in lower growth. Eugene Fama got a Nobel Prize in economics for working that out. Okay, it's from Trevor. If you want to see what my clients do, it's that lesson. Anyone can do it. That's what the government wants people to do. SIPs are, look, Barclays have a SIP. I'm not affiliated with Barclays. Hargreaves Lansdown, AJ Bell, all these companies will open SIPs for you. They're just a tax-free account, so are ISAs. And then you just say I want to buy one share of, I don't know, Costco. That's not a recommendation, okay, or whatever else it might be. Because if you don't and you give it to somebody else to do it for you, and people ask me, well, I don't want to do it myself, but do you know any wealth managers that I can run? No, because institutionally, the conflict of interest means you'll end up with this. So I've never met anybody. If you meet someone, tell me who they are. Okay, but I want to know how they did in 2022. And I want to know why they're underperforming their benchmarks, okay, as well. And why they don't give you all the data. Scottish Mortgage Investment Trust, 50% down. 50%. That's supposed to be a pension. That's what's happening. So we come back to that. If you want to see the performances, you can look at them on the website. Okay, oh, they're here, alpeshpatel.com/shares, and you can see the breakdowns as well. And there's a lot of free resources on there as well, by the way. I've put, so you can see the performances and the breakdowns on there, but there's a lot of free resources. See this? These are worth watching and looking at the free resource. Oh, come on, a few more. It's not working. There it is. So look at all those that you can preview because they're quite good, and that one, and a whole bunch of these. Okay, because I think you'll find them useful to sort of reinforce what I've said. The market did well. Our filtered list did well. Okay, it'll do well in years like 21, 2023. I should update this, 2024. Okay, because the market had a tailwind. Croaky, this is from Goldman Sachs Wealth Management. This is their slide. I stole it. 30% per annum from companies in the top 25% by cash return on capital invested. This is from Goldman Sachs Research, Global Investment Research. The most valuable thing I found is not Croaky. The most valuable factor, if you said to me, what's the most important determinant factor? It's this value growth income algorithm that I put together, and I did it back in 2004, and I've written about it in my books as well. I did it to show how easy it is to beat fund managers, that a simple algorithm could do it without any narrative, without any interpretation of the markets. Value, growth, income, just pick those elements to the stock, and that'll be it. I want to answer some questions now as I go through all of this. Back to front. Chetan, when asking about selling, the drop being 10-50% from the price at purchase, or is it all-time high? All-time high. Or from its current price, basically. So not all-time high, because you might not have bought it then. The highest point since you bought it, let's be precise. Okay. Lots of lovely reviews from hedge fund managers, Merrill Lynch, American Express for my work, BBC, Winford Securities, Financial Times, Coutts Wealth Management, and so on. We've also started doing AI picks just for fun. So this was May 2023, and this bugger did better than I did, because that's just to December 2023. Look at what it is to December 2024. Go look at Broadcom since May 2023 to December 2023. And that was AI. It was still for fun because we're still testing it. You know, I'm not going to risk my son's future on just AI quite yet, but it's fun. Whoops, have I missed anything? Hi, Alpesh. Why do you do three NASDAQ but only two S&P? Because there isn't two NASDAQ. There isn't 2 times NASDAQ. That's why. If you get a 20% improvement on a 500K SIP or ISA, you've made 100K. If you get 10% improvement on a 200K SIP or ISA, you made 20K. Simple as that. So we spun this out of the hedge fund because I want to float this company. What I want to do is put St. James's Place and those wealth managers out of business by giving people the ability to keep hold of their own capital, not charging them any fees, and saying, if we give you the data and the education, one-to-one tutorials, so you've learned to drive, we'll teach you to drive, we'll basically make you your own fund manager, okay? And we'll give you the data for life for a one-off cost, then isn't that the best of all worlds? No conflict of interest, no ongoing fees, teach you to be your own fund manager, like teaching you to drive, give you the data for life. You're off to the races, but giving you access to us for life. Surely that's the best thing. So that's what I do. And what I want to do is get to 350 people. And then I want to get venture capital investment and float it by showing the VCs just how well students have done. Now, we've had some very good years, so the students have done very well. But that's my ultimate ambition as I won't say side gig, because the asset management side is the main gig, but actually as a co-gig with the asset management side. as well. That's what I like to. I'm going to answer some more questions for people. Now, let me see over here. Would you put the same investment in your SIP and ISA or put different stocks in each? I tend to just treat them the same, but that's personal to me because I know I don't need my SIP and I don't need my ISA anytime soon. But if you needed your ISA money sooner, but why would you put lower quality in one or higher risk in another? See, and I've answered this question for clients because they often ask, do you know anything about, yeah, that one I've answered. I've been shorting quantum. What charting package would you recommend for stocks? In terms of charting, relatively free is TradingView and TrendSpider. They're both relatively free. TradingView and TrendSpider are relatively free. I found them easy to use. Would you be able to make a video on when to take profits, which I answered? Lake District, Isha. By the way, if you want to speak to Paresh, he's the co-author of these books with me. He co-launched that hedge fund, authored those books with me. If you want to get a tour of everything that I've explained one-to-one, then he's the person. Torsten Bell, no views at the moment. ISA limits and tax-free lump sums. I think they'll be under pressure because why would you not put them under pressure and take more money into tax? This government's shown that taxation has got to be the key thing. So there we go. You know, go by what they say, not by what they do with governments or people. Once you identify your preferred stock as an investor as opposed to a day trader, do you still watch your entry points and look for trends using indicators on your charts? So what time frames do you? Well, the ones I've shown you, monthly, and no, I have an exit. Basically, the simplest exit route, if you want to keep simplicity, 25% from entry, get out. If it drops 25% from entry, get out. Have 20 stocks or securities. Okay, that's the simplest one. Don't overcomplicate it. There are more complicated ones I give my clients, but just keep it simple, and that's it. Quantum, I already mentioned. Chetan from Bradford, hello, your year of culture, isn't it? If you do want to join, there it is. There's your year of culture. I'm going to answer some more questions. We've got polls. I've done the polls, I think. Attendees. So if anybody does want to join, do, but I'm going to answer some of your questions while we do it. Okay. Mohammed Alpesh, thank you for taking time out. Much appreciated. I'd like to ask, what is the best way to quickly learn the fundamentals of the markets to understand price action movements? CPI came out today. I wouldn't learn about the macroeconomics. I mean, if you want to learn about macroeconomics, I'd say get a macroeconomics book. I've got a bunch of free resources. I'll give you one now. Actually, the book, it should be up. The book, I'd probably say there, but I also explain why I wouldn't look at the macroeconomic stuff because that's more the trading side in the book. And the book you can download from there. I'll put some more stuff up there as well, which might be helpful for you and some case studies. But the book, Investing Unplugged, is there, and that'll probably be a good starting point for you, Mohammed. Hello. Okay, if there's any questions I've missed, let me know. On there, if there's anything I've missed, let me know. Here we go. Would you put? Oh no. When talking about selling, drop 10. Oh no, I've answered all that. That's really good. I know it's a bit late. Let me know what times you'd prefer in future. I know it's a bit late. It's just that I've got a 6-year-old, so I tend to do it a bit later than most. That's a bit of what we're doing. Also, if there's any questions, let me know. Any questions at all? Where are we on the Dow? It's up 703 points. The Nasdaq's up nearly 500 points. Bloody hell. Dow pops out from market access trading close. Yep, pops 800 points. Okay. US banks. Bank earnings seems to be the reason. Fantastic. 10-year treasury yields dropped. Tesla, Nvidia popped 8% and 3% respectively. Look, I'm not a secret. I own Tesla. I own Nvidia. I own JP Morgan. I own Goldman Sachs. Goldman Sachs is up 6.6% today. JP Morgan's up 2%. I've been covering them every week on here anyway. Not all of mine go up, obviously. Even in the best year I had, which was 2023, where we had an 80% rise. We didn't have 80% last year. I'll put the data up on that. It was slightly over 30, which is a bit disappointing because the S&P was up 24, so we should have done more than just 6% more. But anyway, there were still stocks which dropped and we had to exit. There's still no guarantee. There's sadly no guarantee. And that's why you don't just have one stock, because if we could guarantee it, I'd just have one stock, wouldn't I? Okay. So a bit of what we do. Current XRP at $3. Has it? I try not to look at it because for most of my journey, and it's been underwater. So has it gone up today a lot or something? Price hit for the first time since 2018. Oh, okay. Wow. So I better buy some more then. Hey, thanks for telling me, because the downside of not looking at it is that I then forget to buy more. So I think I'll buy some more. All that XRP, all that is for fun. Please don't, people, put your life savings into it. That's for fun. In fact, don't do it if you don't know what you're doing, because it's like buying modern art. Kieran, thank you for the heads up on that. I'm going to get some more later on. I used to buy it through those proper exchanges, whatever they were, really complicated ones with 15 passwords. Now I just use Revolut or eToro. I don't care. I'm probably not getting it as cheap as I could, but it's just so much bloody easier than, the proper crypto exchanges where you had to put in, so complicated to use. I've got friends who've made a killing in the area, but I've got friends who've made killing in buy to let. Good luck to them. It's not my thing. If it's not my thing, it's not my thing. What can I do? Any questions, let me know. All of you signing up, let me know your names and I will give you a shout out as well. Thank you. And also, what other questions have we got? If there's no other questions, I will. Oh, no, Coinbase is good. Yeah, trust wallets. That's it. Trust wallets. I mean, you can tell I'm not an expert in all that area. Yeah, I know. I've heard of it. It just seems a pain. Anyway, I opened a load of accounts and then I closed them and then I just did it the easier way. But I know. I had a friend who gave me a Web3 phone, a phone with an actual Web3 browser. I said, what's the point of it? And he explained something or other. I went, okay, not for me. But yeah, XRP, by the way, I met the team at Ripple. The Bank of England, the reason I picked that was Andreessen Horowitz, the VC firm, the big US VC firm. Incidentally, Sriram Krishnan from Andreessen Horowitz moved back from London. My wife was working with him. And has joined the Trump campaign as head of their AI policy. Andreessen Horowitz, the VC firm, are all over the Trump campaign with lots of positioning in places. And they're one of the big backers of Ripple. Ripple and XRP are related, but not highly correlated. Ripple is the language and the company. XRP is the coin for transmitting money. But anyway, I think there's still a story about this. Bank of England XRP, because I think they were trialing it. But I roadmap real-time growth, someone says yeah, anyway, I can't recall if it was, I'm pretty sure it was XRP. Anyway. Yeah, so the Bank of England have got a whole bunch of stuff on it. And I can't remember. I think they were using it to test. Let's see. No, maybe not. Maybe I imagined it. Ripple proof of concept. Yeah, no, I didn't imagine it. There we go. Bank of England, Ripple proof of concept. We carry out proof of concept with Ripple to explore synchronized movements to different currencies across 2 different real-time gross settlement periods linked across Ripple Connect. There we go. They did. I was out in India at that time with Mark Kearney, and I've got a nice little photo with him, who was the governor of the Bank of England, roughly around then. And it's when I also met the Ripple team, and I thought this is going to go through the roof. Of course, it hasn't. It's just reached the 2018 price today. So which just goes to bloody show you how ridiculous it is. DAGB. I don't know which one that one is. I've got Doge. I'll have a look at DAGB as well. I mean, it's just for fun. It's got to be for fun, because you could go bankrupt on these bloody things, couldn't you? Okay, people, I am going to leave it at that. For those who've joined up, welcome. I am going to send you an onboarding email. I'll probably have a call with you tomorrow to onboard you and give you access to the database, and your first driving lesson with me on how to be your own fund manager and manage your own investments and funds. Okay. If there's any other questions, feel free to put them on, because I will still be able to see them after the webinar, or just email me. You can email me through that link and connect with me through that link. You can ask questions through that link, so please do. Chat, any other questions? No, all good. ETF. Oh, I see. Yes. Now I know what you're talking about. I'll have another look at it. I'll have another look. Yes, now it rings a bell. Thank you again. Thank you, everyone. I'm going to stop sharing the screen. Thank you all, one and all. And